The JMF Advisors Show is a podcast for business owners, C-suite executives, and entrepreneurs who are looking to build, grow, or even exit a business.
We bring in some of our best financial advisors to interview experts on business best practices, hot topics, and sprinkle in some tax and accounting help.
If you're a business owner, startup founder, CFO, or just starting your side hustle, this podcast is for you. All right, welcome back to the JMF Advisors Show. Thanks for joining us today. We have a great podcast in store for you. My name's Bobby Bragg. I work with JamisonMoneyFarmer and JMF Technologies. We've got Kim Smith with us. Hey, Kim.
Hey.
Glad to have you.
Thanks. It's glad to be back.
We have one of those topics that we obviously talk to a lot of business owners. Business owners are always asking questions. What are the things that I need to do to lower my taxes and really maximize business deductions? So we've kind of got a couple of topics that we hear a lot of questions about along the way.
Some of our favorite questions, not favorite, but maybe, just most popular questions. And just wanted to kind of give a few hints for how to maximize those and then go over some changes for 2023.
Yeah.
One of the questions that we have most often are regarding meals and entertainment.
Yep.
And it seems like these laws have flip-flopped a lot over the past few years, or at least since COVID.
Yeah.
Prior to COVID, we were allowed most of business meals, you could take 50% of the meal.
Yep.
But during COVID and in the COVID relief package, they allowed businesses to provide meals from restaurants and eating facilities at 100%.
Right.
Well, now in 2023, we're flipping back to 50%.
Right. So we're back where we started, essentially.
Basically back where we started.
Yeah.
So that means, your business meals with clients, your food items for the office, your meals while traveling for work, meals at a conference, all at 50% deductible.
So that's like, in our case, we bring in food on occasion for the office, all employees, 50%.
Right.
Yep.
And then food for company holiday parties and food are at 100%. Woo.
Yes.
That's a
we
nice.
like those.
We like holiday parties. And then food and beverages given to the public are at 100%. So I guess if you were, if there was some kind of race in front of your office or something and you were donating or you were out front giving out some water or whatever, then that's going to be at 100%.
They run the marathon right by our building quite a bit here in Tuscaloosa.
So dinner for employees working late at the office, you could get 100%. So this is kind of like in the old days and during tax season, dinner will be served at 7.
Yeah.
So, that just encouraged people to hang around till 7 o'clock.
So those three, the holiday parties, the given to the public, and then the late working conditions, those are 100% deductible.
Right. And we're still at entertainment is 0% deductible. So that's going to be cost of entertainment facilities.
Yeah.
Or it's going to be skyboxes, athletic tickets, concert tickets, theater, social events. Those are going to be at 0%. And that's also going to include hunting trips.
Right.
And lodges and stuff. That is going to be at 0%.
So that means they're not deductible.
That's right. And that's whether provided for a client or an employee.
Right.
So basically no fun except eating.
Yeah. So you used to see those as meals and entertainment as in one line. Typically now we're saying break those into separate lines in your GL.
Right.
For the obvious reason.
We during COVID, especially or during the time at which the COVID relief package was in place, we would ask that you put your 100% meals in one category, which would have been all business-related meals and those other items.
Right.
And then items that were 50% deductible were things like where you go to Costco or Sam's and buy snacks for the office, or you bought something at a convenience store or something. Those should have been at 50%.
Right. Gotcha. So again, we want to reiterate because we get this question a lot. The skyboxes, the
football tickets, the hunting trips.
Yeah. All of that is 0%.
The girls' beach trips are all 0%.
Yeah. All right. So if you think it through on the fun stuff, probably not
Yeah.
deductible. And we kind of touched on this, but what about dues for, the country club or, again, the hunting lodge or something along those lines?
Dues for athletic facilities or athletic clubs, golf clubs, social and country clubs, those are not deductible.
On your business expense.
Right.
Yep.
As in a business expense. But let's say that you took a client to play tennis at the country club and y'all had a meal afterwards to discuss business or whatever, then that's going to be the meal portion could be 50%. So again, breaking that ticket out when you're entering it in would just help identify what part was deductible versus non-deductible.
Right. And again, the more that's deductible, the lower your tax.
Right. Because we're going to maximize those deductions.
Right. So what about professional organizations, chambers of commerce, things of that nature?
So your trade associations, your professional organizations and business leagues and civic organizations are 100% deductible.
Okay.
So I do want to mention that a lot of your trade associations may have optional or required donation to a PAC, a political action committee.
Yeah.
And so that political part of the dues are not deductible.
Right.
So again, when you enter that, if you could drop that down into your political line item, donation line item, then that would be helpful. It just keeps us from asking a question at the end of the year, how much of this was dues and how much was political contributions.
Right. A lot of times when you're signing up for the annual association, there's a little checkbox. Hey, do you want to put $50 towards the political action committee for whatever association it is? We see it a lot. The builders group. We have them through the AI CPA and things of that nature.
Yeah.
So once you check those, and I mean even our local chamber has its own political action committee as well. So again, break those out, and they show up in different spots on your detailed income statement as well. All right. So for business owners, a lot have automobiles in the business. There are certainly different ways to approach that from a deduction standpoint.
There are two.
Yeah.
You have a choice when you buy your automobile, whether you're going to choose the actual expenses or you're going to choose the standard deduction, the standard mileage rate. I don't know why I have that. I have even has that written down.
Yeah.
But the standard mileage rate or actual expenses. And so the difference is that your actual expenses are going to include the actual depreciation, licenses, repairs, gas, oil, insurance, etc. And those expenses might produce a larger deduction in the first year.
Right.
Because of depreciation.
Yep.
And for the standard mileage rate, those might not produce as big of a deduction in the first year, but they may produce a deduction for a longer number of years, depending on how long you're going to keep the vehicle.
Right.
And how many miles you drive in a year. Obviously, if you are a low mileage person who changes cars often,
right,
the standard mileage is not going to be for you in actual. And most businesses are going to choose that actual mileage because they want the big hit of the depreciation in year one.
Right.
And then they want to be able to write off repairs as they incur them because, one set of tires is, could wipe out the standard mileage rate. Yeah. Although for 2023, the standard mileage rate is 65.5 cents a mile. And that's the highest I think it's ever been. I don't remember it being any higher than that.
No, for sure.
Nor could I. And it's going to be really interesting to see if it ever gets to $1. Maybe I'll be retired by then.
Yeah.
If that happens. But
I bet you it's something. Well, I wonder how the EV, because all of the, expenses related to that, that's an interesting topic. There's so much less repair and, you're not doing oil changes on an electric vehicle, So I wonder how that will change.
You get the credits.
Yeah.
I think there are credits available for those vehicles. So,
but most business owners, if they want they want the big bump from bonus depreciation, they're going to take the actual deduction. So
Right.
let's talk a little bit about bonus depreciation, because I
Yep.
know there's stuff that's changing this year and the next couple of years. So
Yeah.
put that on people's radars for sure.
We have been in a situation where we've been taking bonus depreciation at 100% for many years now.
Yeah.
And so it is starting to phase out and sunset in the next few years. And so for 2023, you're only going to get 80% bonus depreciation.
Right.
Which means if you spend some $10,000, you're going to get to write off $8,000
Right.
total, and then depreciate the remaining $2,000 over the useful life of the vehicle.
Right.
We still have Section 179 out there too as an alternative to bonus, but I think people were used to writing off everything that they bought, and so they just need to be cognizant that it's only going to be 80% this year.
Yeah. And one thing to note, at the end of last year, when we were doing things to do at the end of the year, I think we talked a little bit about that bonus depreciation switching. So we were if you were going to make a vehicle purchase sometime in December or January, our suggestion was if you wanted it in December, you got the 100% deduction for 2022, and then it was going to be 80 in 2023. So if you had the ability to make that choice, you would make it sooner.
Yeah, people need to realize, and I have to explain this to clients every year, that the only way the only way you're going to get a really big bump in depreciation is year one of the vehicle purchase.
Yep.
And year two of the vehicle purchase, if you don't purchase a vehicle that cost more than the original purchase, when you trade in or get rid of that vehicle, you're going to have to recognize a gain because you've depreciated all of it, right?
Yeah.
So the only way you're going to get any benefit from the new vehicle is if it costs more than the old vehicle.
Yeah. The way car prices are going these days,
I don't think that's going to be a problem, but you never know,
That's
because you don't want to be surprised when a client asks you, if you don't go a little further and say, well, as long as that vehicle costs more, I mean, they could be trying to downsize and trade down or something, and then that new vehicle is not going to help them at all.
That's right. Yeah, that's good. That's a great point. Okay. Anything else? I mean, on the standard or the business mileage rate, I mean, we got to do logs and all that.
Yeah,
stuff.
and I wanted to mention that for meals too. When I said you needed to keep your receipt, you need to document, who the meal was with and what the purpose of the meeting was for. And these need to be contemporaneous.
Right.
It's really difficult to figure out what the purpose of a meeting was 2 years ago, right?
That's right.
So same with vehicles. If you opt for the standard mileage rate, you're going to need to have a contemporaneous log of your mileage, which in the days of apps is a lot easier than it was keeping a little thing in your car and putting or a calendar or whatever. So I would encourage you to research some apps and figure out which one's best for you to keep up with your business mileage if you're going to do it that way.
Right.
Same with meals. Excuse me. Same with meals expense.
Yeah.
I mean, there are apps where you can just take a picture of the receipt and it logs it and you fill in your info right then. And
yeah, those are fantastic. Just it almost forces you because it takes the picture and then just says who was there. And then, business purpose line where you say, hey, we talked about refinancing a building or something like that. Or financing a new vehicle for the business. Or something along those lines. So, yeah, I mean, the contemporaneous part, that's the part where people have the most difficulty.
Yeah.
So those apps that really do help you track that are probably worthwhile. Like you said, I can't fathom trying to go back and say, oh, we had lunch in March 14th of 2021. What did we talk about? Wow.
COVID.
Yeah. Were we allowed to have lunch in March 2021?
I can't remember.
There was a time when we could, then we couldn't, then we could again. So yeah, what were we talking about then? We probably were talking about COVID. Was your office back open again?
Yeah.
So always good to have that stuff contemporaneous for sure. And then it also allows you, hey, if you do get a audit request or information request related from the IRS, you don't have to You don't have to go back and.
Funny story. I
Yeah.
used to be a auditor of the state of Alabama many years ago.
Yeah.
And we did an audit on this person one time who had so much mileage on their Schedule C that in order for it to work, they would have to drive from the top of the state of Alabama to the bottom, to the beach, and back every single day of the week. So, needless to say, they didn't have a contemporaneous log, and it was all disallowed.
Right.
I think we did allow them some reasonable mileage, but literally, I mean, they were. I mean, who's to say that might not be correct, but it wasn't documented, so they didn't get the expense.
Right. Yeah. Wow.
I guess that's a funny story for me, but not for them, huh?
They probably weren't laughing. I don't
No,
think when that got. Okay. Another business owner question we get a lot is, can I employ my children, and if so, how do I pay them, et cetera? So
Yeah, you certainly can employ your children, and you can pay them up to $13,850 in 2023 tax-free. Income tax-free.
Right.
You still would have FICA and Medicare, and you'd have, your SUI and FEDA on them. But for that little amount, it's going to be insignificant. And that, incidentally, is the amount of the standard deduction or personal exemption for a single person.
yeah.
Um,
Is it typically minors, or it could be minor?
it could be
Anyone. Right?
Could be anyone.
Yeah.
Yeah. I mean, I know people who especially employ their college age kids. It's a way to deduct some of that expense. I mean, they do work for them. And that's the other thing, what they're doing for you needs to be age appropriate. You wouldn't want a toddler as your janitor, or,
Right.
You wouldn't want a toddler employed, period. They need to be employable and be able to do whatever job it is that they're being paid to do.
Right. Got it. And again, that there are certainly state, so it could be up to the standard deduction at the
Right.
federal level, but not the state level.
Right. If you have a state income tax, it could be where, they may owe some state income tax on that, since the threshold for their filing is a lot lower for state purposes.
Yeah. Okay. Pass-through entity taxes, PTETs.
Mm-hmm.
I
That's
know.
the hot new topic.
Yeah. Do we call them PTETs, or do we call them
think-
PTETs?
Well, it's both. I think.
Yeah.
I think we're all just, at one point it was just PTEs.
Right.
Now it's PTETs, and then I've heard PTETs. And I think we're just trying to find our way to what that nickname's going to be.
What's it going to be? So speaking of nicknames, SALT is another one. We call our state and local taxes SALT, and it's not just us. We all
Count
do
it humor, I guess. We love an acronym.
So we did have a podcast earlier last year about state and local taxes.
Right.
You did that. You run our state and local
Right.
tax group. You did that with Blake Madison. Did a deep dive, and
Yeah.
y'all were ready to go for
We were all
hour
up
or
in it.
two if need be, but we'll probably come back to that one. So if you are interested in a very deep dive of state and local taxes, that is on an option, back earlier in your podcast feed, I guess.
Yeah, I just wanted to briefly mention that PTETs, because it's a way around the $10,000 limit at the state level. I mean, at the federal level for state taxes. So you can basically, the pass-through elects to pay the tax at the entity level. The shareholders or partners get a credit for that tax directly in that year on their state tax return, and it's deductible on their federal tax return. In other words, the income coming through the pass-through entity already has the state tax deducted out of it.
Right.
So you don't have to worry about being limited to $10,000 state tax on your federal Schedule A.
Right.
And at the time, even at the time when Blake and I were podcasting about that, and I think that was probably January, December, whenever we were doing those.
Yeah.
That set. More states have come on board with it since
Right.
then. So I think the only time it's not going to be beneficial is if you have really low state income tax, or maybe you're not making a lot of money, or your
Right.
income's basically zero. The more taxable income you have for state purposes, the better that's going to be for you.
Right. So there are a handful of states that don't have a state
That's
income
correct.
tax. in this area, Florida and Texas
In Tennessee.
and Tennessee jump out. But there are others, but over 30, I think, have the
Yes.
pass-through option. So, I think for most folks, that's probably a good option.
Yeah, and I think it's a good idea just to have your tax professional look into it and see. There are some considerations if you don't make estimated tax payments the year prior to the year that you're going to elect it. You may have some penalties in there. So the timing of when you're going to elect it, you want to see if those penalties outweigh the federal deduction that you're going to receive.
Right.
So I would definitely, if you pay a lot of state tax, and especially if you're limited on your Schedule A to $10,000 for state tax deduction, then you should look into it. And
Right.
an owner of a pass-through entity.
Right. And then those multi-state entities, where they pay state taxes in multiple
Yes.
jurisdictions, that's obviously a big deal too.
You're gonna have to look at that and just see if it's beneficial.
Right. This is definitely one of those areas where you want to talk to a tax
Yes.
professional to help. The question probably is, am I limited at any point in my state?
Is this something we should look at, and can you run me a projection
Yeah.
of what this is going to save me?
Awesome. That's great advice for business owners out there. And then we talked about, financing or refinancing real estate and things of that nature. If you're acquiring businesses, let's talk about cost segregation studies then.
Yeah, this is if you are purchasing a new building or you are purchasing an older building, it's your first year to place it in service, but you're doing a lot of renovations. You may want to look into getting with a professional who performs cost segregation studies to accelerate the deduction for depreciation on that building. And what the cost segregation study providers come in and they segregate out the 5, 7, and 15-year eligible property in that building so that you could take bonus on those, or even just the shorter life itself instead of a 39-year useful life for the entire property.
Right.
And usually if the property is over $1 million, then it doesn't cost anything to get an estimate of what the cost savings would be. But I think it's always a good idea, if you're putting in something in service over $1 million, to see what the time value of money, what the present value of that deduction is worth.
Right. So you're still going to depreciate the entire amount. It's just over a shorter amount of time. So, it's probably valuable. And that's good. I'm not sure I've heard that one. So $1 million is a good cutoff point of.
Some people say 500,000, but it's
tough.
Because the study costs, they put a lot of work in those, because you're breaking out every, electrical connector, every, cabinet, so the cost, it's a cost benefit analysis at that point. Usually over $1 million, I think it's a given that you definitely need to mention it to your client.
Right. Yeah. So, we also did a
podcast on that too,
with
the McGuire people at McGuire Sponsor,
right?
Who helps us with ours,
right? So that's one of those cases I think where, again, if you've spent the money, it makes sense to have somebody look at it, run the numbers for you again on, does it make sense for you?
Doesn't hurt, and it doesn't cost anything to get an estimate,
right?
So why not?
Yeah, and there are certainly things. It's one of those cases where if you only plan to be in a facility for 3 years and then you're building something bigger, then it probably doesn't make sense.
Yeah.
But you always have to kind of take those specific circumstances into play when looking at things.
That's right.
Well, those are some great tips for business owners to try.
I hope so. I hope it's been helpful.
Yeah. Any maybe parting shots or anything like that?
I was just thinking, owners of businesses typically have some expenses that they pay out of their pocket that they don't necessarily run through the business itself. They probably want to either develop better habits to, get reimbursed for those expenses so that they are deductible, or consider taking them if they're an owner of a pass-through at that level. But, I would look into getting some of those apps to help me keep track of those, that I could put them back to the company, and I can make sure that there's a proper paper trail in there to where, you didn't cheat yourself out of taking those expenses.
That's right. So the more expenses that are in the business, the less tax.
That's right.
Your less tax bill you pay for the year, and we want everybody to, spend every dollar they have to, and not a penny more.
That's
right?
exactly right.
Awesome. Well, very, very much appreciate you spending some time with us, giving us all that great information.
Sounds great. I enjoyed it.
All right. So I hope you enjoyed today's show, and Kim, I certainly appreciate you being here. If you could rate, rate, and review our YouTube channel, that would be fantastic. And certainly, if you have any questions about today's podcast, you can or have ideas for another podcast, feel free to send those into info@jmf.com. And again, thanks for hanging with us today, and look forward to the next show. Thanks.
To the next one. Bye.
Yep. Bye-bye. If you would like us to help your business, or would like to suggest additional podcast topics, simply send an email to info@jmf.com.
And don't forget to subscribe to our podcast on YouTube and your favorite audio podcast apps.